Welcome back to another video in the options series. This is lesson 6, and we're going to talk about understanding risk and reward. And so the goal of this video is to teach you how to evaluate potential profits and losses on any option trade before entering it. And this will include using payoff diagrams, understanding max gain or loss, and comparing risk profiles across strategies. So every options trade you place has a unique risk and reward profile. And so knowing what that profile looks like before you click the button is one of the most important habits you can develop as a trader. In the options world, your risk is what you stand to lose if the trade goes against you, and your reward is your potential profit if the trade works out. These profiles can be visualized using payoff diagrams, which you can see right here. And so we've already seen a few back in lesson 2, and now we're going to use them to dive deeper in how different strategies behave under various market conditions. And so the basic framework is when you buy an option, long call or long put, your maximum risk is the premium you paid, and your potential reward can be much greater, even unlimited in the case of long calls. When you sell an option, which is a short call or short put, you collect the premium up front, but now you're exposed to potential obligations, and you can risk, your risk can be much higher. And so the question is why this matters. Well, if you don't understand your risk and reward before entering a trade, you're flying blind. You might risk you might risk more than you think, or cap your upside without realizing. Let's get into it. So long call. Let's start with one of the most common option trades, which is the long call. A long call is a bullish position when you buy a call. You're paying a premium for the right to buy the underlying asset at a specific price, called the strike price, before expiration. Example. Suppose a stock is trading at $100. You buy a $100 call option for $5 premium. The $5 is your maximum risk. No matter what happens, even if the stock drops to zero, you can never lose more than $5 you paid. But what happens if the stock goes up? At 105, you break even. Which is right here. You break even, which is the strike price to premium. At 110, your option is worth $10, and you've doubled your money. At 120 or 130, the profit just keeps growing. This is why this trade is so popular. You have limited downside, but unlimited upside if you're right on the direction and timing. This is like a high reward, high risk trade, but the risk is fully defined, and you know from the start. Now let's look at the short call. It's like the mirror image of the long call we just covered. When you sell a call, you're agreeing to sell the stock at a fixed price if the buyer chooses to exercise, and in return, you collect the premium upfront. At first glance, this seems appealing. You get paid right away, but as the diagram shows, the risk is anything but small. Let's say you sell a $100 call for $5 premium. If the stock stays at or below 100, the option expires worthless and you keep the full $5. That's your maximum gain. But if the stock goes above 100, especially far above it, you're on the hook. Let's say the stock explodes at 120. Now you may be forced to sell the stock at $100 when it's worth 120, and that's a $20 loss per share minus the $5 premium you collected. That's a $15 net loss. And so what happens is your profit maxes out at 5, and it happens only if the stock stays flat or drops. The moment the price crosses the strike, your losses start. And as the stock continues to rise, losses become theoretically unlimited. And so this is why it's called short calls. This is why short calls carry one of the riskiest profiles in options trading, especially when uncovered. Short calls can work, especially when part of a spread or hedge, but they must be managed carefully, and they're not ideal for beginners without risk control in place. Let's kind of flip the direction and look at a long put, which is a bearish strategy that profits when the underlying asset falls in value. This is the mirror of the long call. You're paying a premium for the right to sell the stock at a specific strike price before expiration. It's a smart way to bet on a drop or to protect yourself from one without shorting the stock outright. Let's say the stock is at $100. You buy a $100 put for $5. If the stock stays above 100, the put expires worthless and you lose the $5 premium. That's your maximum loss. But if the stock falls at 95, you break even. And at 90, your put is worth $10, a solid gain. So in this one, as the stock price drops, you make money. And what happens is long puts are often used for multiple things, speculating on price drops, hedging against downside in a long position, or combining with calls for more advanced strategies. Now, on the other hand, there's the short put. A short put is the most underrated strategy in options, especially for investors looking to acquire stock at a better price while getting paid to wait. How it works is when you sell a put, you're giving someone else the right to sell the stock at the strike price. In return, you get paid a premium upfront. If the stock stays above the strike, nothing happens and you keep the premium. That's your maximum profit. If the stock drops below the strike, you're likely to be assigned, meaning you'll have to buy the stock at agreed upon price. Let's say you sell at $100 put for $5. The stock stays above 100, the option expires worthless, and you keep the $5 premium. If the stock falls below 90, you're assigned shares at 100, but you've already collected $5 premium, so your effective cost basis is 95. And if the stock crashes to zero, your max loss is $95 per share. So what happens is you're taking on real risk, but you're not doing it with a defined floor. You're doing it with a defined floor and getting paid to do so. So what happens is in this orange payoff diagram, your profit is capped. You can't make more than the premium. You can't make more than the premium, but your downside is increases as the stock drops. And break even is clear marked strike minus the premium. And so the strategy works best when you'd like to own a stock but at a better price. You're comfortable taking on an assignment. You want to generate premium income in neutral to slightly bullish markets. And it's also key building block for income strategies like wheel trades or spreads. I hope this video was quick. It just kind of showed you the diagrams of each option. And yeah, I hope to see you guys in the next one. Thank you.